Tucker from Soltis, and I can't remember your name from Soltis.
Bill Wallace.
That's right, Bill. Sorry, Bill. And Bishop from Voya. He was threatening to come here live in person, but I know there was a lot of flight issues over the weekend. So I was just thinking, jump in the car and drive. It's only 10 hours.
It would be nice, actually.
PJ is running our Zoom meeting, and then Brandon, our manager of benefits, is online too. I do want to welcome our newest member of the committee, Jeremy Walker. Welcome, Jeremy. He is our finance director for Utah County. And so we are excited to have someone with his expertise on the committee. Want to say thanks to Brian Vokes, who has been on the committee for several years. He's moved on to, he's still with Utah County, but he's now working for the assessor's office. So yeah, this will be great with this new group. So let's start. Let's pull up the agenda. Does anyone else have anything real quick before I get jumped into the agenda? Anything they want to share? Okay, let me find the agenda. So the first thing will be to approve the minutes from our last meeting. This was on August 8th. I did have Tucker send those out again, even though they are in the notes here for this meeting. But I just we need to make a motion. I'll wait for Eric. He's just coming in.
I can make that motion to approve the minutes.
I'll second it.
Okay, we have a motion and a second. All those in favor to approve the minutes from August 8th?
Aye.
Aye.
Aye. Motion passes 6-0. Thanks. Did we have any follow-up items for our last meeting? I don't have the minutes at my fingertips. Does anyone have anything from the last meeting? Any follow-up items? Okay, well, we'll turn it over to Soltis.
Okay. Thank you, Ralph and committee, and appreciate the flexibility today. We're sorry, we were planning and we wanted to be there in person with you, and just appreciate the flexibility. We've got a few personal things going on with family and health that it was beneficial for us to be home. I don't want to be the one that has to explain to Tucker's wife that he was at Utah County when she gave birth to their third child. So, but anyway, thank you, and we look forward to being there in person next time in our next meeting. So, Tucker, do you want to go ahead and share screen, or I can? We'll just put this. I know we sent out the meeting material for everybody. Jeremy, welcome to you and as being a member of this committee. We're looking forward to working with you. And I think probably one of the first follow-ups we'll do, Jeremy, is we'll typically, when new members of the committee come on, we'll take some time with you to kind of do some what we call fiduciary training, just around the plan and some of those things. And so unless you're opposed, we'd love to reach out in the coming weeks and maybe just schedule a little bit of time with you just to help you familiarize with kind of the documentation, the governance, the process, and then roles and responsibilities of each of us on the plan, and of course answer any questions you have. So I'm sure with your finance background, this may not be your first rodeo in terms of being part of a retirement plan committee, but we look forward to working with you and would be more than happy to spend a little bit of time just to help you get up to speed. With that, you can see the agenda in front of us there. We'll do a quick update on a couple of fiduciary items. We'll have Bishop kind of go through the plan demographic report or the plan statistic report from Voya. As we've kind of planned, he'll spend a few minutes on the ease and spending account each quarter as well, so to make sure that the committee has a full accounting of those. And then we're glad to have Bill Wallace, our Chief Investment Officer, joining us. We'll give some time to Bill and let him go through a little bit of economic outlook as we look into 2023, as well as kind of report on the investments in the plan. We do have a couple of items to address and one potential change from one of the funds that are in the plan. And then, of course, we'll finish with just a recap. I know with the move to Voya this year and, GoalMaker to managed accounts, some of those changes, we are grateful for Brandon and his efforts to help coordinate with Tucker and our team on education. We want to give kind of a full report there. So, as always, I know there's a lot that's on there, but is there anything that's not on the agenda that we need to make sure and address today? If not, Ralph and committee, with your permission, just based on maybe time and a little bit of priority, if we're okay, I thought we'd maybe make a couple of adjustments on the agenda just in terms of timing. I thought maybe we'd start with Bill and let him kind of go through the economic outlook and the investments and go there first. And then turn the time over to Bishop on the Voya, and then we can have Tucker. I want to make sure we give plenty of time around the participation and education that's kind of happened throughout the year, because we want to be able to kind of report on that for not just the last quarter, but the full year. And then we can kind of finish with a couple of these fiduciary items. So any objections to changing the order a little bit to just make sure we spend time and cover it?
Nope. I think that sounds great. Thank you.
Okay, perfect. So Bill, let's start with you. And we'll let you kind of jump in here, and Bill will tell us his crystal ball, and as we look into 2023, and it's been a little bit tougher year, obviously, with this year, but we'll go through it. So, Bill, I'll turn the time over to you.
Well, Tucker, why don't you take us to slide 20, and I'll focus on some of these, major major economic indicators and some investment. So it's been an interesting year in terms of growth. The gross domestic product, as you may recall, we had 2 negative quarters in the first and second quarter of this year. And, that is one of the definitions of a recession. So there was a sense of, well, maybe we've had a recession. It's interesting, though, at the same time, we've had really a very low unemployment rate. We're still hovering near a 50-year low on the unemployment rate, and job growth has been very good. So we don't have that here on this particular report, but the third quarter gross domestic product report has come out recently, and it was actually positive. So there's an interesting question of where we go into 2023 with the economy, and we'll talk about that maybe down towards the end. I did mention job growth has been very strong. We're hovering in that, mid-single digit 3.6, 3.5% type of area for unemployment rate. That is a 50-year low, as I indicated. So probably, as the Federal Reserve has been pretty aggressive raising interest rates this year, we think we might start to see that unemployment rate go up as we move into 2023. You've seen a lot of announcements from particularly large technology companies about significant layoffs, and that may start to spread more throughout the economy as we get into 2023. Speaking about interest rates and valuations, the stock market, as you know, has had a really tough year, and at the same time, the bond market's had a tough year. So it's been a tough investment environment for traditional financial assets. Real estate, in some cases, has held up better. But it's been an environment where there's kind of really no place to hide. With the markets, the valuation ratio you're seeing here is 15.9 times earnings, which is, fairly close, a little below a 25-year average. If we bring that to today, we're actually at around 17 times earnings, so we're close to that 25-year average. So I guess our look at the market is it's, from a price earnings basis, it's not expensive, but it's also not inexpensive. It's just running near averages. Interest rates, the Federal Reserve's been very aggressive in raising the federal funds rate. We actually have a negative sloping yield curve where short-term rates are higher than long-term rates. So, for example, the 3-year Treasury bill or the 2-year Treasury note both have higher yields right now than the 10-year Treasury note, which obviously the normal slope for a yield curve is to have longer rates the further you go out. So that inversion is another one of those things that could lead to a recession as we look forward. Inflation has been a real problem. That's the primary reason why it's been difficult for financial markets this year. You may recall in the June time period, we got up into excess of 9% inflation on the consumer price index. Most recently, we've gotten down below 8%. The most recent CPI was about 7.7% range. So there's some sense that maybe we've seen peak inflation, and we'll be working our way down. I think that's a definite possibility. I think one view we have on inflation that maybe differs a little bit from most market players is a lot of market players seem to feel that inflation is going to roll right back down to 2%. We don't think it's going to be that quick, that it could take, a couple of years for us to see inflation get under control. But nonetheless, it is a positive to see it rolling off of those highs that it hit earlier in the year. The dollar has been very strong. U.S. has been, as usually is, seen as a flight to quality, a flight to safety when things get ugly. And then our interest rates have moved up faster than other major international foreign economies. And so that's been an attractive place for money to flow for investment reasons. But lastly, around all of this, what about recession risk? We think recession risk is still elevated, and that 2023 the economy may continue to kind of struggle with this maybe low growth to perhaps negative growth, and so that's kind of our outlook for the economy. In terms of financial markets, fixed income has become much more attractive with rates rising. So money flowing into fixed income is we think, flowing in at a fairly good time. Equity markets are still probably going to be more range bound. And what we mean by that is you'll have some periods where the markets move up, followed by periods where it moves down. We'll probably have to see, a change in Federal Reserve policy and perhaps some fiscal policies to try to help the economy move into a recovery mode. But I'll stop there and just ask the committee if there's any questions or any areas you'd like to dive into a little bit more.
Yes, I was just curious about the relationship between stocks and bonds and how that tends to correlate inversely. At least that's my understanding, and yet they're both getting they've both been hit hard this year. Is that just because of the rate of increasing of the rates of interest? Is that what's causing that?
It's a great question, Ralph. The normal scenario, probably 75% of the time, bonds and stocks move inversely, as you suggest. And that's one of the reasons why bonds are a great alternative asset, or an asset to combine with equities, because they do tend to be stable or hold their value when the stock market struggles. But one particular environment where they tend to move together is inflation. And so it's really a function of inflation. So this year has been one of those times where bonds didn't really help and reduce your volatility. And so that's what we've seen. And like I say, there's not always an inverse relationship. That's the normal, but you can get them moving together, particularly in an inflationary environment.
And Bill, maybe to just add a quick comment, I think to give you, the bond market it's been extremely difficult, for investors typically holding those assets to help protect them, and they haven't had that protection. This is, to again, give some perspective, you have to go back to basically the 1930s to see a market where bonds have had a more difficult time or have had negative returns like we've seen this year. So, I mean, it's tough for stocks to come off, more than 20%, but then when you turn around and the bond portion of your portfolio has been off, 15 to 20 as well, that's made it I would say a tougher environment than most would have anticipated. And then, yeah, those inflationary pressures are, they're not the only driver, but they're certainly probably the largest when it comes to bonds.
One difference is, that one of the things we're seeing now, we don't have credit issues, terrible credit issues like they did in the 30s. And that's one of the main differences here is you do have inflation, but credit quality tends to still be pretty strong among corporations and among consumers. That may start to be tested a little bit for consumers as we move into 2023. But one thing I would point out is that when we meet with plan participants and do our education, we're going to, encourage them. This is an environment where, as you're putting money in every paycheck, your dollar cost averaging in at more attractive prices. And we would, again, help them look at this as the long term for them. Obviously, people that are getting closer to retirement need to think more about preservation of capital rather than growth. But nonetheless, that's the way we would approach this in our education sessions.
So this is
go ahead.
Rob
Your
Moore.
questions?
Yeah, this is Robert Moore. I have a couple questions. With these economic indicators, in particular, that they've been negative over the last couple of quarters, do we need to be reviewing what we're offering to employees as far as investments and consider making any modifications? And if so, what modifications should we make?
Well, I guess I'll take a stab at that, Tyler, and then you can.
Sure.
The way the plan menus are designed is and I think that's the case here. They're kind of all-weather menus, if you will, that there's things in the menus that allow the plan participants to have a broad, diversified portfolio that should work over long-term cycles. One thing maybe to note, and Tyler and I haven't talked about this, but just in my preparations earlier for the meeting, I did notice that a lot of our plan menus have inflation-protected fixed income funds, which would be something that the committee might want to consider. Other than that, I think it's a pretty sound menu, and I don't think it's not sound without it, but that's one of the things that we tend to see in other fund menus is an inflation-protected securities fixed income fund. But Tyler, thoughts from you?
Yeah, no, I'm glad you bring it up, Bill. I think so. I believe that was Robert, right, asking that question. We do look at the environment. I think to Bill's point, we try and make sure the menu is kind of an all-weather menu, regardless of kind of what the markets are doing. Given that inflation is such a poignant part of the market or risk at the moment, Bill brings up a great point. We could in the fixed income right now, Metropolitan West, and they do some things in that bond fund to help try and, protect against inflation, but they haven't been immune this year. And there is, I think one of the questions for the committee is we could add a specific inflation protected bond fund in there. It's what's called a TIP, Treasury Inflation Protected Securities. And there's funds in that space that we could add. The other one is like an explicit real estate, as Bill mentioned, for clients that we manage accounts in the last 2 years, and particularly this year, having kind of non-traditional assets, which many of those you can't put into a retirement plan. So we do a fair amount of business in what we call alternatives. But one of those is real estate, and certainly having a explicit real estate position in the plan is something we could look at. And I think The inflation protected bond type of fund is a consideration that would be very specific to inflation. I think real estate would be inflationary, but would also have other merits for being in the plan, and one that we would like to have a discussion with the committee around about, potentially adding one or two of those to the overall menu. But maybe with that, open it up to the committee. Would there be opposition or your thoughts around adding one or two funds, one that would be explicit to inflation protection, and one that would be a real estate specific?
So I was, thinking about that if we did recommend that, or if that's something, Soltis recommended and then we did, chose to approve that, could that be seen as an encouragement for someone to move into that when the market's down, which we don't necessarily want to do? That's my only concern.
Yep.
Anyone
And
else
I
have
think
thoughts on that?
with those ads, Ralph, they would be additions. So I think our expectations we wouldn't map anything. In other words, we would just say these are additions to the fund menu, and if people want to go in and elect money to go in there, they can. I think another comment I would make is for those that are in the managed accounts that we are managing, we actually do have exposure inside of the portfolio that we're managing there. We have a little bit of exposure to both of those type of positions.
Has there been any requests? No. For that type of fund? I've not talked to anybody specifically either, but.
Well, the process, Tyler, we'd come to the next meeting, right, with some proposed funds to consider.
Yep, so I think that's kind of the question for the committee. If you'd like, we have a couple of funds in those spaces. We'd be more than happy to kind of come and go through them with you. And if the committee felt it would be good to add them, we could. If not, not a big deal either. But would that be a good follow-up from that question, Ralph?
Yes. I think it would be something, we want to follow up on. I don't know if we want to take any action today on it, but we should follow up.
This is Robert again. I think if you were to bring those back on our next committee meeting and with a recommendation as to whether we should be looking at those and adopting those, I think when you talk about inflation protected bonds, what you're talking about is someone is basically, if they're purchasing those, they're banking on that inflation is going to rise a lot more than it is now. And so they're banking on inflation at 9% is okay, but at 16%, if they get in this other form, then that's a benefit for them. So I think it's just, if we're offering options to our employees, I think that's a positive. Whether if they're sophisticated enough to be able to choose those options, it's a different issue.
Yep.
I just had a question about like the real estate options. Would that be like in the form potentially of like a REIT, an REIT, I think is what it is. Is that potentially what that would be?
Correct. Yep. For two reasons. A REIT is daily liquid, meaning you can trade it daily. So it would have an NAV, what's called an NIV or net asset value that's priced every day. So you don't have liquidity issues within a plan. Yep.
Does that REIT also distinguish between commercial and residential properties? Do they lean one direction or another?
Yeah, the REITs that we use are typically almost all commercial. They're not really into, they may have some residential, but what I would say is there's a few things we look at. One is national diversification. So you have real estate exposure that's not specific to one area of the country. And then as well as diversified holdings. So you're looking mostly at commercial type of holdings, things like hospitals, apartment buildings, but very few of those that we'll look at, they'll have minimal or no exposure to kind of like residential, or nothing in them that's, like house flipping or anything like that. You're looking purely at maybe a little bit of home building or whatnot. But for the most part, it's predominantly commercial.
So Ralph, this is Rob Moore again. I'm not sure if we need a motion, but I think a recommendation from the committee that we come back with those items that have been discussed would be helpful.
Yes, I
Reflect in the minutes.
exactly. I don't think we need a motion, but let's make sure that gets in the minutes that we have them come back with those recommendations.
Yep.
Thank you.
We'll make sure we plan to do that, and we'll come prepared in the next meeting to go a little bit deeper on each of those offerings and what they would look like. Okay. Bill, I'll go back to you. If there's other questions, good questions.
None
You
for
want to
me.
jump into the investments, Tyler?
Yeah, let's do that, Bill, while we've got you going. I think let's cover that. We can go through a quick review of the plan assets and then just, we do have one fund change to kind of report on. It's the Metropolitan West, which was on watch last time. We've continued to do due diligence there, but this is just a quick asset breakdown across the different assets across each plan. So this is for the 401k plan, and then if you go down one page, Tucker, this is for the 457, and so we keep a breakdown there. I know one of the follow-up items from our last meeting was trying to reconcile these a little bit. I think we're still working with Voya and what we call Orion. Orion's kind of our software that we have a download from Voya. And so what I'll just say is there's a little bit of these numbers on the right are a little bit underrepresented. We're missing a few numbers that are not coming through on the download. We've figured out where the problem is, but we haven't figured out why exactly it's not coming through. So forgive us a little bit. We're working to try and get that corrected in these. And I know the reports that Bishop has will kind of show you the asset amounts. We're not off by a ton, but they are a little bit. It's about 4 or 5 million, I think it is, in the last time we looked. So if you'll go down, Tucker, to page 28. Again, this just breaks down for the committee a quick summary of the investment policy statement criteria that all of these funds are measured against on a regular basis. And this is, again, a quick summary. There's quantitative as well as qualitative metrics that we are looking at on every investment in the plan. And if you go down to the next page, Tucker, this is our, what we call a consistency report. Again, we're looking at all the funds in the plan. Those that have, if you look in the middle here, you'll see this quantitative and qualitative status, and 2 green check marks means that they are meeting all of the criteria in the plan. If you see a yellow watch like that, that means that that fund is in violation of 1 or more of the investment policy statement criteria. And you'll see right now, of all the funds in your plan, we have 2 funds that are on watch. So a pretty small amount, but we'll report on those in just a second. And then over on the right, average excess return, highlighted in green, is all the managers in your plan that are not only outperforming their investment policy statement criteria, but they're exceeding it by a pretty wide margin. So that margin is 1% or more. And you can see there's quite a few investments in your plan that continue to perform really well. I'll just point out this the Barron Partners that you see here at 9.26. I know we continue to keep a close eye on this manager. I think, as most of you recall, they've held a pretty sizable position in Tesla. And obviously there's a lot going on around with Twitter and Elon Musk at the moment, but if you continue to look at the performance of that overall fund over the long term, it's continued to have really strong numbers, although, again, we continue to watch it very closely. You can see, in your small cap areas, we've had good, strong performance there. The Wasatch Small Cap Value, which is a fund that we replaced not too long ago, you can see performing well. And then, of course, just looking at your target dates, you can see that across the board, your target dates are outperforming, and the majority of them are outperforming by 1% or more. And those that are not at 1% or more, they're pretty close. It's 78 basis points and 66 respectively. So, and then if you go, right here at the bottom. So the average performance of the investments in your plan versus their benchmark right now, they're outperforming by about a 1.95% margin. And they're beating that benchmark just under 90% of the time on that 5-year rolling number. And so those are good, strong numbers in terms of, again, what we would look at the investment menu and say, are the funds, are they good quality funds? Do they represent different areas of risk and return? And then are they performing at a high level? And I think we would look to those numbers to feel like the menu's in pretty good position for the plan and the participants. Any questions quick before we jump into these 2 that are on watch? If not, Bill, I'll maybe let you jump in here. I know the last time we reported on Metropolitan West, and I'll let Bill jump in here because he's been closest there on, we do have a recommendation here to replace this fund with a Dodge and Cox income team.
Yeah, I'm happy to. So Metropolitan West is a bond fund and bond manager that we've used for many years in our firm. We've thought highly of. More recently, we've started to have some concerns, strong enough concerns that we're thinking it may be time to change funds here. I'll tell you a little bit about some of the reasons for Metropolitan West. You know, one of the things we really like and monitor carefully when there's a turnover in the management team, and a long-term CIO for the firm, Tad Revell, has now retired. So there is a concern for that. One of the things we like historically about Metropolitan West is they have a four-person management team, but losing Tad as chief investment officer has been significant. And if we just kind of look forward, two of the other three members of that team are the same vintage, if you will, as Tad. I mean, the other two are probably nearing a retirement announcement. So there's been some turnover in the management team, which is a red flag to us. Secondly, we've just kind of lost conviction, and probably more importantly, we've lost conviction in their ability to deliver outperforming returns. You'll see in the chart here that we're looking at, Dodge and Cox is the fund that we want to introduce to the committee as the replacement fund. You'll see in the quantitative review, Dodge and Cox is in the green and has delivered consistent, outperformance over, periods of as short as 1 year out to 10 years. Unfortunately, Metropolitan West has historically had much better numbers, but now they're basically looking at, lower peer group ranks at 1, 3, 5, and 10 years. And if we have more confidence in the ability to turn around, I think we'd say be patient. That's typically where we are. But in this case, we think that Dodge and Cox has a more sound strategy, a more deep team, broadly based team. It is a gold ranked fund by Morningstar. One of the things we like here, if you go down to the middle bottom, the expense ratio area, we do move from a 0.65% fee to a 0.41% fee. Both of those fees are reasonable, but obviously a 0.41% fee is attractive. If you go to the next page, Tucker, this is a write-up that we've done for this fund, and then we have the recommendation and just the bullet points. If this would be a summary of some of what I've already said, there's turnover in the management team at Metropolitan West. There's that underperformance kind of consistent that we're concerned about them being able to reverse that. We've had some concerns with the investment process. Maybe to get a little more granular there, where we would have expected them to outperform is during the period of, typically they do really well in difficult economic environments. And when we went through COVID, we were kind of expecting that they would really shine, because that's historically the type of period, when things get really messy in the markets. And it just didn't happen this time. And then also, so concerns about investment process. And lastly, just that very attractive expense ratio at Dodge and Cox. So I'll stop there and see if, Tyler, you have anything to add, or committee members, do you have any questions?
I would just add that this has been a good team. They came on watch in June, and they were just barely on watch. So they weren't off by much, but we've had a close eye on them, and I think Bill's articulated it well. I think, when a manager goes on watch, we take additional time and get on the phone, even visit them on site if we can. And, what's come from those additional conversations is I think we just feel like the departure of the one team member and their process is not quite as tight as what we've seen it in the past. And therefore we feel like maybe there's some slippage going on, and the Dodge and Cox team, we feel differently around and feel like it's just more conviction in that particular offering.
So what would you recommend on the timing of this change?
So we'd look to do that, as soon as possible. It's usually about a 60-day, looking at Bishop a little bit here. This notice goes out to the participants of the change. If the participants that are in the Metropolitan West choose to do nothing or don't do anything, they'll automatically be moved to the new fund. They'll be notified 30 days before the change. So if they do want to make a change or go somewhere else, they can.
Maybe one thing for the perspective of the committee too, just looking back up to the 401k plan, Metropolitan West has about 2.58% allocated. So 3.5 million. So it's not a huge, it's definitely used by plan participants, but not a major position.
Maybe just a quick question. Did I see the ticker right? It's DCDIX. Is that correct?
It's Dodge and Cox is DODIX.
Yeah, we would use the DODIX.
Okay.
Share
Just
class.
this one letter. I just want to make sure that it's available. I'm sure it is. I've seen the fund in other lineups, but I want to double check the availability.
Yeah, please do. We've carefully had that conversation with them, so it should be available, Bishop, but certainly check that box to make sure.
Will do, Bill. Thank you.
And I guess with that, Ralph and committee, is there any objections to that change?
There's none for me. Anybody else on the committee have any objections?
You want a motion?
We will need a motion to replace Metropolitan West with Dodge and Cox Income One.
I'll make a motion that we replace Metropolitan West with Dodge and Cox Income One.
Okay, do we have a second?
I'll second.
Okay, we have a motion and a second. All those in favor say aye.
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 Motion passes 6-0. I'll add this to the agenda item for the commission to approve.
We'll of course wait, Ralph, to move anything until we hear back from you.
Okay, thanks.
Tyler, do you want me to take a little bit of time on the blue chip growth?
Yeah, I think there's not as much change there, but if you'll just do a quick refresh, that fund was on watch last quarter as well. We continue to watch it, but yeah, if you'll do just a quick few minutes on that, Bill, I think it'd be good to update the committee.
I would say here, and this situation hasn't changed. We have had a manager turnover, not recently, but within the last couple of years, time period. Paul Green has taken over. Paul had some time with Larry. There was about a year and a half where they worked together. Paul worked on technology and communication sector fund that was a top decile performing fund. We have concerns here. They are underperforming their benchmark. They're still a silver ranked fund by Morningstar in terms of people and process. We have, I guess, them on a relatively short leash, but we want to give Paul some time to see if he can, get this thing back. I mean, this has historically been one of the best large cap growth funds in the country. And we just think it's, given the quality of the T. Rowe Price organization, the strong analyst team that supports a portfolio manager like Paul, that we want to give them some time to see if they can start trending. You'll notice that we have this trending section in the lower right of our write-up. We're hoping to see that starts to trend, that short-term performance starts to outperform. We want to give them a little more time. we have to, I think we're in a situation right now where we can't give them much more than another 6 to 12 months, but we're still going to be patient on this one before we come to the committee with a decision to make a change or a recommendation to make a change. But so far we haven't seen that trending happen that we're looking for, but we want to give it a little bit more time. Questions on this one? Okay, Tyler, sounds like we're good.
Maybe one final comment on the fund of, can you go back to page 29, Tucker, on there? The target date funds, which I highlighted earlier, continue to perform at a strong level. I wanted to just kind of maybe put this out for an agenda item for the next meeting. We've been working diligently, and I believe coming into next year, we'll have an additional price reduction for these target date funds with T. Rowe Price in those collectives. And so we're anticipating in that next meeting, we'll plan to have an agenda item where we can kind of come and show what we expect that reduction in price would be based on Soltis's growth and relationship with T. Rowe and kind of what that would mean to the plan. So just letting you know that, as we continue to grow, there's benefit obviously to Utah County, not only to have access to these lower cost CITs for T. Rowe on the target date space, but that as we continue to grow, that pricing will continue to come down. So we're excited and eager to kind of probably show you that in the first quarter of 2023.
Okay, sounds good. Thanks.
Okay. With that, I think let's, on the agenda item, I want to maybe just, Bishop, if you're okay, I'll maybe turn the time over to Tucker, just with the transition, I think, and for the committee, we wanted to make sure we had plenty of time to kind of just go over the education and all that's been done on behalf of your participants. Again, we thank Brandon. He's been key in helping us coordinate, and I think we've had good responses. But Tucker, I'd like to turn the time over to you, and then Bishop, after Tucker, we'll plan on having you go through that plan report. Will that work?
Yeah, that's fine. Thanks.
Tucker, I'll turn it to you.
All right. It's been a busy year, as I'm sure we're all aware, with the plan transition. So maybe just as a summary, kind of recap how it's gone so far this year. So in January, we brought on another team member to help with those monthly on-site meetings that we have. And we've seen some really positive trends as far as these meetings go. Actually, let me pull up the business calendar, because that does a good job of summarizing where we've been. So by the end of last year, I think we were tracking for about 130, 150 individual meetings or individuals that would come and sit down with us. And this year we're already a little bit above 200. And we anticipate by the end of the year we'll have met with about 250 to 300 different individuals to talk about their retirement plans. And as you know, this is anybody who wants to sit down and talk with us. We think this is a great sign that, the services are being used and that people are interested to sit down and meet. And, some of that might have to do with the plan transitioning over to Voya, which we know would have generated a lot of questions. But we also saw, in addition to that, people just having good questions about retirement in general. So on top of having, oh yeah, go ahead.
Just a quick comment. So that represents face-to-face individual meetings. This doesn't represent when your participants call in and we help them that way. This is kind of more of the on-site that we track, because I think we know that those meetings tend to, we tend to try and be able to get things done and make behavioral changes or help make adjustments to the account. So.
Yeah. And just as a reminder, so those are where we're on site for 2 days, and it'll be me and Fano. And Brandon and his team has done a good job of cycling us around the different locations. We've been at the Public Works, we've been at Admin, the Health and Justice, and even down to the jail. So we've been able to see a huge swath of different locations and these types of meetings. So we really enjoy them, and we hope that if you have any feedback there, we're always happy to hear that. On top of the individual meetings, we've been present at a lot of group meetings as well for the new hires. Last year we had about 14 different group meetings we're on site for, and just with the transition happening, we've been able to participate in about 17 different overall group meetings, whether it's new hires. 4 of those were getting people acquainted with the new Voya website. We worked in conjunction with Voya for 3 of those, and then we've also had our own little meeting with the participants to go over managed accounts and the website again. And on top of that, and Bishop will probably go over this a little bit more on his report, but we've seen a really positive trend in overall plan participation. And it could be that there might be a difference in, I don't know why there would be, but you can see there at the end of the last year, the participation rate in the plan overall, in the 401k plan, was about 91%. And as of the end of September, it's gone up to about 98% from what we've seen. And then Bishop I got that from your report, so maybe you can go a little bit more in depth there. But happy to see that the plan participation is high, and we think that that's a combination of, when a plan moves, there's a lot more high touch points going on there. On top of all this plan-specific education, we have some general and universal or global education. So we got the quarterly webinars that have been pretty high attended. We've got some pretty broad topics that we've been able to cover as well, anywhere from crypto to insurance to inflation. And those are all recorded and available for your participants if they would like to ever see those. And then, as I also mentioned prior, we did some on top of our just 2 days a month. We were happy to offer additional days of education for the plan participants once the transition happened, and happy to do that too. So, anything else, Tyler, there that you'd like me to go over?
No, so I think, Tucker, just so we have the 2 days a month, and we have 2 advisors that are there on site. I think you can help Tucker there. It seems like the demand is good. We fill up pretty quick, and I know that Tucker and Fano and other team members, when we need to pull them, stay busy. And I would just say, in conversations brief, albeit with Brandon, it sounds like the feedback has been positive, and I think your participants and employees are appreciative of the opportunity to do that. Of course, there's other mediums for them to connect with our advisor team as well. They can call in any day. They'll get sent to Tucker and Fano first, just so they're familiar with the plan and familiar with who they're meeting with. And then, of course, when they have an interaction, those participants have the ability to go in, and if they get an email from Tucker or Fano, they have the ability to go in and schedule time on their calendar as needed. And then maybe the last thing I'll just reiterate with the committee is many of those conversations are much more broad than just the 401k. Both Tucker and Fano are CFP designated certified financial planners. So when those participants have questions about budgeting or debt or credit cards, they're qualified to help in those conversations as well. So we know this is a really important effort for your employees and participants. I think it's one that we pride ourselves on making sure we have a team that can be available to your employees. And so important for us to, see the progress and make sure that the employees are using that and getting benefit from those services as well. So maybe just pause there if there's any questions or comments from the committee about kind of our monthly, quarterly, and then just annual efforts in terms of engagement with your participants.
Yeah, I think it's been very effective. I think this last year has been really exceptional when it comes to educational opportunities. I just wanted to ask, are we planning something similar for the upcoming year? And maybe, Brandon can also, jump in if he has any comments as well. But I guess what I want to say is I'm really hope that we do something similar, if not more, if possible, in 2023.
And this is Brandon. I know there's no change. We're going to be doing this at least once a month. What I would like to see, Ralph, and we struggled a little bit getting some excitement over in the sheriff's office at the sheriff's location. I definitely want to push a lot of time and attention over there. It seems like a lot of our questions, benefit issues, especially when it comes to retirement planning, seem to come more from the sheriff's office. Now, given they're half our workforce, so maybe it's just the volume of numbers, but I would like to try to make sure that we're providing the proper opportunities for all sheriff's office employees to meet with Tucker and Fano.
Brandon, can I ask, in terms of the first of all, I know Fano and Tucker, the more time they can spend with police officers, the better.
The better.
Correctional, that's just their, that's where they like to hang out. But are there certain topics with that group that would be good for us to focus on and educate to?
Well, the one thing that's always going to be interesting for them, since we do participate with Utah Retirement Systems, for our sheriffs that started before 2010, they're eligible for a full URS participating retirement after 20 years in the system. So we sometimes will get a lot of these public safety individuals ages, 50 to 55, already looking to retire. And so kind of even, not thinking about people like me and Ralph that have to work until, 65, 70, 75, 80, they get out a little bit sooner. So for them, what are they doing with those 20, 25 years in the system to maximize their value for when they may have an early retirement? Not all of them, fully retire, but I do see a lot that, they do retire. They have enough to live off what they have, but that's kind of the conversation with public safety. And then
we also talked about, would being on site separate day other than Thursday and Friday work better for the sheriff's office?
I've got let's see, we have, I think we saw Yvette's in the room. She might have the best, for the people here, she might have the best perspective, although she's not over at the sheriff's office, but she probably understands a little bit from the enforcement, corrections, and judicial side what would be best. So we could see what Yvette may have to say about it.
What I would say about the employees in the sheriff's office is it's like herding cats, and they are a difficult bunch. What? Yeah, they're really difficult. Sometimes it comes down to just plain what's the most convenient for them. A lot of us have vehicles, so on the enforcement side, we're able to travel around, and it shouldn't be an issue, but sometimes it just feels like if it's not convenient for them, they hesitate to schedule things, don't want to necessarily go outside the sheriff's office for meetings. I think they do, in general, have a lot of concerns about what the market looks like, how that could potentially affect their retirement down the road. I think that it might just require a lot of encouragement for sheriff's office employees specifically to just, make that appointment and sit down and ask their questions, because there's not anything to be afraid of. And there's not a stupid question. We, on the law enforcement side, are always concerned that if we don't know something, that we may look dumb if we ask the question. So there could be some of that hesitation as well.
Sorry,
So-
Yvette, you're kind of cutting in and out.
So I was curious. This, I guess, is a question for Yvette. Do you think it would be helpful if we tried to schedule meetings when you're already having meetings, like staff meetings, or I'm not sure how that's set up, but do you think that would make it easier if they're already having a meeting for all the deputies or the sergeants, and then we have them come into those meetings?
Yeah, I think sometimes if they are required to be in the area for some reason, they're already bucketing out some time. So then it makes it a little easier to schedule just, an extended appointment if they're already going to be on same site. Sorry, let me switch. Can you hear that better? Sorry about
Yeah.
that. What I was saying is it may be very useful if they're required to be on site for some reason. That might be more convenient for them to actually schedule an additional meeting, because they don't have to leave the area. They're just already there and they've already bucketed that time out.
Okay. Well, we're happy to work with Brandon and his team to get some time scheduled over there, and we can do virtual, on-site, and so we'll make note of it to definitely put an effort that direction.
I think also, Brandon and Yvette, if we need to do a session that kind of talks about how the 401k fits into their URS retirement picture, we'd be happy to do a topic specific to that, to just talk about how the two work together and how they should be thinking about it, and maybe, how they should be participating in both.
I think that would be very helpful, and I think especially now that people are much more familiar with Zoom meetings and how all of that works. We've got guys out in the field that can't break away, but they could pull over and they could do something on, their cell phone. They could do a Zoom meeting. And I know that our supervisors specifically, it's kind of nice to not have to leave your area. So if something does go awry, you're right there. It's really convenient just to click online and take a meeting that way.
Yeah, if we could do that, and then we can also do it as a recording, so that even if they're not able to, you guys could send it out to them and just say, hey, this is a recording that kind of talks about the most basic things around, URS and your 401k and what you should be thinking about.
Yep, I like that.
Okay.
I think that would be very helpful.
Okay, we'll have that as an action item, Tucker. And then I think the other one, Brandon, you mentioned it. I think we'd be eager we kind of have some thoughts going into next year, but certainly building out kind of to Ralph's question for next year, kind of building out the calendar and the number of things around education to do to keep the momentum that I think has been building.
Yeah, and we did have some local entities, like there was like a Mountain America Credit Union that would provide a series of educational seminars. Since we don't have a formal agreement with them, we've discontinued that. I know previous to Voya with Prudential, like they had a series of educational seminars where somebody would, there were several topics that we lined out. There was one a month that we had scheduled. So there could be good value brainstorming with you and Tucker, what not only just topics that you could present, but what resources you guys may have as well to bring in. I mean, sometimes the meetings only were attended by, 15, 20 individuals, but it meant the world to them.
Sure.
And to Yvette's point, if we could record that and make it available, then anyone could watch it. And that's where we seem to be getting a lot more participation, is in making things available at the employee's convenience.
Yep. And I think we've got a whole slew of kind of financial wellness, Brandon, I'll call it, financial wellness content that, again, anything from budgeting to debt to retirement to all, health savings accounts even. So I think we can certainly kind of, I think what we'll do is put an action item to kind of get with you, Brandon, and we can kind of go through and look at those different topics, then look at the timing and really kind of lay out the calendar for this next year.
Yeah, that'll be great. I'll be available to participate and help get that set up.
Tucker, anything else you want to touch on?
Just a final comment is we have our upcoming global retirement readiness session coming up on the 15th and 16th, and that's where we just get an estate planner, Medicare specialist. We know it's more geared towards people that are getting close to retirement, and anybody's welcome to join that. So you should see something soon to send out to the employees who would like to join that.
Well, there's two, right, Tucker? We have on the 8th. We have kind of an annual for your participants. We're doing a webinar on just kind of what's an annual checkup on your 401k look like, what should you do at least annually, and then the retirement readiness that Tucker mentioned. So you'll be getting, all of you committee members should be getting tomorrow morning the invite for the December 8th, and then the retirement readiness one will come just a few days afterwards, and those are for all of your employees. If they want to attend, they can.
Mm-hmm.
Okay. Thanks, Tucker, for going through that, and appreciate your efforts. And again, thanks to Brandon as well. Brandon, we appreciate all your help in coordinating. We know that that's no small task to kind of coordinate where and when and who and how often. So thank you. Bishop, we've taken a lot of time, so let's turn the time over to you.
No worries.
Go through your items from the Voya side.
Okay, and I'll go ahead and share my screen to show the report to everybody. Maybe as I start, just for Jeremy's sake and for the committee's kind of a reminder, last quarterly meeting I had shared, or actually went through, I guess I should say, 3 separate reports, and we consolidated that down into just a simple summary, if you will, of the key items. as well as you have the 3 separate reports too for you as backup information with regards to this. So hopefully this report, which I went through with Tyler and Tucker and kind of consolidated key facts, is helpful for you. Happy to adjust this as we go through it, either this time or in future meetings. Just let me know what might be most helpful to you all, and we'll cover that in coming meetings as well. Some table contents here, just a couple things to go through quickly, but I threw the 3 plans into a single summary with regards to the cash flow of the last quarter. In some ways, these numbers are nice to look at, but I will tell you they're a little bit obsolete already. At the last quarter, there was pretty significant depreciation in a couple of the plans, but I would tell you these numbers for all the plans except for the time-limited plan are now, I should say, current asset levels for all the plans for the 401k and 47 plan or above what these beginning period numbers are. So when you see 145 million for the 401k plan, we're actually up to 142. The 457 plan is just over 20 million. The time limited plan is just under that $2.4 million level now. So numbers are good there for you to have and to see what the activity was in the quarter, but outdated based on the activity that occurred in October and November to date. And I'm sure given the markets, we'll see more volatility in those numbers on a go-forward basis as well. Tyler had mentioned earlier on, as he kicked things off, to have me go through the spending accounts and the ease accounts with you. I did include in the report a full spreadsheet that captures this, but on a single slide, just to show you where we were as of September 30th, the spending accounts for the 401k and the 457 plan, roughly 109, almost $110,000 in total assets there. Those assets have not changed since the end of the quarter. The ease plans, though, these are reflective of the administrative fees that are collected by Voya that are assessed against participants' accounts and held on your behalf and for your use. You can see here total across the 3 plans, $42,000. At the end of the quarter, we did do a distribution to Soltis for both Q2 and Q3's fees, which were not paid out. So that's just over $2,000 of the active data balance as of today. But again, that account will fluctuate with time as we're collecting assets from participants as we assess the fees and as we pay them out. But so the total balance here actually of 151 is more like $112,000 as of today, just so you know. And again, those are assets available to plan for use as they direct us to expend them. Did want to give you just kind of a summary when you get a snapshot of the plan over time, and we'll show this on a quarterly basis as well. But 401k, 457, and time-limited plans all side by side. Again, not a surprise here with regards to the decrease in assets within the plans on a quarterly basis. But again, given what I told you earlier, a little bit irrelevant as to where we stand as of today as well. This is something that wasn't captured in our last report, and want to make sure that you understand what you have with regards to total participants using advisor managed accounts. And this is the conversion of plan participants and assets that came from GoalMaker. So you can see, 401k plan, 457 plan, and the time limited plan, and what those totals are. Not a large change, quarter to quarter. All total, 1,458 participants at the end of the quarter across the 3 plans that are participating in the AMA plan that Soltis manages for you. The assets within those plans as of the end of the quarter, 59 million, did decrease a little bit. I don't have readily available stats on the AMA assets, but based upon what I know was showing up to me on the 457, 401k, and the time limited plan, that should be probably over that $65 million as of today. But again, slight decrease, as you can see in the K plan and the 457 plan, TLP plan is fairly flat at this point. I won't spend time here. I only captured this, and I know Tyler had this. I do want to make reference, Tyler, if you or others at Soltis need, September 30 data on specific funds, it's not coming through, let me know. I have access to some of that data too. And maybe if I can pull it and send it to you, I'm happy to do so until we get things worked out.
We may hit you there, Bishop. It's just a download that Orion, which is our portfolio accounting system, pulls from Voya. I think there's a little bit of, we're just seeing a little bit of discrepancies there. So we may hit with a question or two as we try and just get that solved. I think we kind of know where it's happening. It's just now trying to identify it a little bit. So, and for the committee, that doesn't have any impact on your plan. That's simply an internal Voya downloading the plan info to Soltis so that we have it and can track it through our reports and systems.
Happy to help if you need to as well. I put this page in specifically just so you could see, because it's not, I wouldn't call it significant movement, but you did have movement in each of the plans, well, except for the 427 plan, which stayed flat, of participants within investment options to the fixed account. Not, something that's atypical with regards to movement to security assets like the fixed account, but did want to make sure it's highlighted for you. Jumped from 71 to 117 in the 401k plan and 137 to 170 in the part-time or the time-limited plan itself. Participation rate, Tucker hit on this a little bit, but we'll track this on a quarterly basis for you too, so that you can see on a side-by-side basis what's happening within the plan. But as Tucker said, 98%, 99% of participation in the K plan. I'd have to dig into the numbers a little bit for you, Tucker, to see where that's coming from. All I use is a straight, mathematical view of total eligibles that Brandon gave me for the plans versus those that are participating. So pretty straightforward computation on our part. And then you can see in the 47 plan, participation rate roughly about 17%, which is fairly flat. And then 72% in the time-limited plan at the end of Q2, but jumping up to almost 79% at the end of Q3 as well.
And Bishop, on that last column, the time-limited plan, our participation rate for active employees in that should be 100%. I run an internal report for any active time-limited employee that's not showing enrolled at a minimum of 7.5%. So there might be something in there where the population that you're calculating against might not be an active employee. So we'll have to take a look at that column and see that to get that trued up, because we do track that every week to make sure it's 100% for active time-limited intern-type employees.
Okay, good to know, Brendan. I'll reach out to you as we come to the next quarter and talk through some of these numbers so I can make sure I'm tracking the right numbers on my side.
We'll put that, Bishop, just as an action item in the follow-up notes for you and Brandon to coordinate on. Make sure we do have that, make sure you guys have got that right on your end.
Yep.
Thanks, Brandon, for clarifying.
Yep, definitely. Thank you. Did want to look at distributions a little bit, just so you had a picture of what's happening within the plan. And basically, just total plan distributions is what's captured here, both on a dollar basis as well as a number of rollovers basis. In some ways, these numbers are good to look at, but until we have a couple quarters under Voya's belt, the numbers don't mean a lot. But did want to make sure that you could see, quarter over quarter, there was an increase, which I would expect, given we have a full quarter of activity, both for total assets going out the door as well as number of rollovers themselves. I did then break those out into the top 10 rollovers that are going out as to where they're going. So you can see Fidelity, is picking up the lion's share at $1.5 million. Nearly $500,000 going to URS should be service buybacks, which is not surprising to me. Typically, you see that in multiple plans where that's an option. And then from there, you can see just a handful of other providers who are receiving assets coming over to them in a rollover out of the plan. Included loan information also, although the total number of loans went down slightly, it's fairly flat overall. Total outstanding loan balance of $1.9 million at the end of the quarter, and only 7 new loans instituted during the quarter itself as well. Couple different slides for you just to capture some of the information that's happening. I did go over this, I know, in each plan last time, but this just shows you how your participants in each plan are interacting with us. And as I think I said last time, not surprisingly, that most people are using internet or mobile access to look at their accounts or institute transactions with us. So no real surprises here to point out to you. In the next slide, I also captured call center statistics for each of your plans. Interesting thing for me to note, you had no calls abandoned within any of the plans where you had activities with our call center. That's unusual. You just see ones or twos, coming up. But for your sake, your participants are pretty, I guess I would say, patient, although the timing with regards to the calls is pretty short as well. That ASA column there, that's the average speed to answer. So that gives you a glimpse of how fast our call center is answering calls coming in, as well as how long in the long column how long the calls are lasting in that far right column with the wrap time as well. So roughly an average of a minute and a half, minute and 20, and then 37 seconds when the time is. I won't spend any time really going through this. I just through this slide. I just probably more so for Ralph and for Brandon, want to make sure you're aware that there are changes that are going to be carried out to the sponsor website that you have access to through Voya in the coming quarter. Three different areas in which these fall under, but it's a redesignment of the participant listing, which in your case, it's not really something that's going to make an impact for you. What's happening is on the participant listing, you'll see inactive employees highlighted now separately from active employees, so you have a different way to go there. There is some customization with regards to the take action tile that's on the homepage of the sponsor site. And then there's the ability for you as administrators of the plan to make some customization of yourself for the tile order and the training help section as well. So I'll spend time going through the rest, since this captures, for the most part, what those enhancements are. And again, they'll be coming later in the quarter as well. Unless there are any specific questions on the reports or the ancillary items that I provided you as part of the meeting, that would conclude everything for me.
I have a general question. What options are available if someone wanted to do a rollover into Roth, whether that be a 401k Roth or an IRA, Roth IRA, or any options available in our plans?
Well, I guess you have two options, right? You could, on an internal basis, convert your assets that are on a pre-tax basis into a Roth account. You can do that within the context of the plan, keeping those assets in the plan. But as far as external options, then you'd have to go an IRA route if you wanted to convert assets over into an IRA or into a Roth IRA product. We don't have anything that's affiliated with the plan itself.
And what you do there, Kim, is you'd roll it over to an IRA, and then once it's in the IRA, then you can convert it to Roth assets, which you'll of course have the tax implication
right
with that conversion. So
is there a
and that's a conversation that we're adept at having in terms of being able to help a participant look at that if they need to.
Okay, that's good to know. Is there a form you have to fill out if you do it internally, or can you just do it out there on the website? Or
you can go through the website on the internal conversion or through the call center, either way for that. And then there is a form. I can get a copy of the form and forward it on to Brandon and Ralph, and also Tucker and Tyler, so they have it for the future as well.
Okay, thank you.
On that issue, this is Rob. I looked into that issue once recently, and my understanding was that the fees that go along with the Roth at the conversion, especially if you go outside, are much higher than our fees that we have inside. Is that what you understand?
Yeah, so Robert, a lot of times if you roll from a 401k account over to an IRA, and in particular, if you're having somebody help manage that, the plan as a whole is paying a lower fee because you've got a much bigger asset base, as opposed to if an individual takes their account and goes to an IRA where they're working with an advisor, typically you're going to see the advisor fee significantly higher because it's just that individual that they're working with in regards to that.
Okay. I did have a Voya question though. In the past, and it's been kind of a distance past, I think Brandon and Ralph had received some complaints when we were converting over to Voya. Have those all ceased? Are we still receiving complaints about Voya's website or other things that we need to address while we're here?
That's an excellent question. I have not received any recently. Brandon, how about you?
There's two items. Bishop, Tucker, and have been made aware. Tyler, possibly. Issue number one: the mechanism for contribution, like setting your percentage on Voya. Voya did update their website, and they disabled the ability to select a contribution amount to the 10th. So as we're trying to match 6.2%, employees had to pick 6% or 7%. They couldn't type in 6.2. So I haven't gotten the update on that yet. And Bishop may have to reach out to Jennifer or such to get that, unless you could speak to that now. But I haven't seen that that's been fixed. Now, there are about 3 ways that you can update your contributions on the Voya website. It's just the primary one that kind of sticks it in your face and says, this is how you should do it. It's not allowing it to go out to the 10th. So that's issue number one, and it hasn't been resolved yet. Issue number two, we've had some public safety employees that have tried to set up distributions from their 401k that are at age 50, and something with the customer service side of Voya, the plan documents did not allow for these public safety to draw on their 401k at age 50. And I believe that is also being reviewed, and Bishop can probably speak to that as well. So I'll let Bishop see if there's any updates to those 2 items.
Yeah, so let me speak to the first one. So that issue, you're right, Brandon, is still not resolved. As of this morning, I didn't see an update on it, but you're right. There was an upgrade to the participant website experience, and in some fashion, that triggered a change from that 10% to a whole percentage change. It has been flagged internally, and we've got our IT teams working on it to determine what's taking place or why it's taking place, but still no update on that as of today. So that should be forthcoming at this point. On the second item, I think what's happening, I think we've got this fairly closely to being resolved. I think what's happening is the plan sponsor, the call center is not recognizing the fact that that individual is termed from the plan, and either they're not seeing the term date on file or not recognizing that regardless of age, there's a term date on file and they do have access to that money. So we're still working with the call center to resolve that one, but there shouldn't be a problem with those individuals, especially if there's a term date on file for those employees and having access to their money on a go-forward basis.
Bishop, on that first item,
Yes, sir.
the 10th percentage, is that something your IT is working to fix? That was an unintended consequence of the upgrade, and they're just working to retroactively put it back in?
Correct. Right.
Okay.
Thank you.
I think I'm not sure if you've shared your, slide deck with us. Bishop, have you sent that out?
I forwarded it to you, Tyler, and Tucker.
Okay, that's what I thought. I just wanted to double check. It had
Sorry,
a
Ralph,
lot of very. Oh, sorry. Go ahead, Tyler.
I was just going to say, sorry, Ralph, we'll send that over. I knew Bishop had sent it to us, but that's probably my fault. I didn't realize that it hadn't gone to you guys as well. Bishop's been really good to work and help us kind of condense it down. So we'll make sure that as soon as we get that we forward that with our material as well.
No, I think that's great. It has some great information in it. I actually really like that. I was wondering about, Fidelity. Are they, targeting our employees as they retire? Why is there so much rolling that way? Any thoughts?
So I would probably answer it this way, Ralph. I think one is Fidelity's one of, if not the largest custodian, and I think their brand name, they get a fair amount of, when people say, hey, I want to roll my account over, Fidelity is usually the top of the list just because it's a name people are familiar with. So in that regard, that's not a rare thing for us to see on plans, that they tend to be one of, if not the largest custodian. The other reason for that is a lot of independent advisors, us included, we use Fidelity as a custodian for some of our individual clients. We use Schwab as well and others, but you'll see a lot of advisors, they'll custody assets at Fidelity. And so I think some of that's representing, advisors as well that are maybe working with some of those participants, and they're moving their accounts, and that advisor happens to custody their assets at Fidelity.
Okay. I was just curious. It seemed like a very large amount, but that's yeah.
Fidelity's cup runneth over, that's for sure.
Thanks.
You do also have a Fidelity service center based in Utah as well, so could be a little bit of employees, feeding off of the family members.
Yep. Good point. Okay. Any other items, Bishop? Thank you for the report, and Ralph and committee, we'll make sure and forward that entire deck to you all so you've all got it. And again, my apologies there. I think just the last couple of items from our standpoint are kind of fiduciary related. One is we want to get on your calendar. So our annual fiduciary training conference for 2023, those dates are locked down and ready. So I'll share those with you, and an invite will be coming in the coming weeks, but that is April 27th and 28th, which is a Thursday and Friday. Again, that'll be down here in St. George. And we'd love to have as many of you as committee members. You'll all get the invitation for that training. It'll be a similar format to last year. We'll have kind of conference sessions each morning on the 27th and 28th. And we've got a couple of good speakers already lined up, and looking forward to that. So you'll see an email invitation coming in the coming weeks with kind of a save the date for that. For next is this was just barely hit kind of late last week with the holiday weekend, but the current administration has made some changes around what's called ESG guidance for plan sponsors, and so I'm not sure, some of you may have seen that. You probably didn't, but in our next meeting we'll plan to kind of come and give a little bit more detail. There's still some kind of gray area in that, but what I'll just tell you is the former administration essentially had taken the stance that as a plan sponsor you could not just consider ESG dynamics or metrics for selecting the investments in your plan, and all the investments had to be selected based on their risk and return kind of merit. And the current administration, the Biden administration, has recently changed that to say if you do want to look at ESG factors, we're going to allow you to do that. So we'll plan to kind of cover that with the committee, but I know that's something you're going to probably, if you haven't seen already, you'll probably see in the coming days, because that is a pretty big change from the previous policy, and not a surprise. I think most of us expected the current administration to take a different stance than the former one, as we all know how politics tend to go. So, and then the last couple items, I think this was shared in the last meeting, but there's new limits for how much you can put into retirement plans going into 2023. I know Bishop had kind of sent that out to the committee, and we have it in the packet. Tucker, do you want to just maybe bring that up real quick? But I think it's worth noting this is some of the largest increases we've seen in a long time in terms of what people are able to defer, and you can see it there. And so, of course, Voya, they'll have this coded into their system going into 2023 so that participants going forward, if they want to be able to max out or increase their contributions to those limits, they'll certainly have the ability to do so, and that will kind of be taken care of. But you can see it there all the way from 401k to 457, highly compensated employees, what that looks like. So if you have any questions, let us know, and if there's any need to communicate some of those limits out to your participants, let us know, because we could help coordinate that as well. And then the very last item that I've got, and this is maybe more of a discussion. I know Robert was at our most recent fiduciary training in November. We talked a little bit about a committee charter. Robert, I just wanted to circle there in terms of the fiduciary governance and documentation. I know that the committee was, I know, Robert, you were looking at that a little bit in terms of the current documentation that the county has in place. And I just want to circle back there if there's a need for us to dive in there or even help potentially draft a committee charter, or if that's already covered in your current kind of documentation and governance for the county.
You know, I did look at that after a meeting. I don't recall. I pulled the document. It does have, did I send it to you, Tyler?
I don't think I've seen it, but we're more than happy to. I haven't seen it recently. I'd say that, Robert. I think, you know, a while back with Dave, I'm trying to recall if he sent that to us as well, or he just let us know that it was in place. And maybe for the committee, one of the things that we talked about in that fiduciary training is the committee charter kind of spells out the responsibility and the authority that's been delegated to the benefits committee for overseeing the retirement plan. And so the importance of that document is it just spells out how decisions are made, what process is followed, et cetera, so that it's clear and concise from a responsibility and a liability standpoint of how that works. And we typically will help draft that for plans if they don't have that in place. And I think the county, as part of your documentation around your benefits committee, kind of has that addressed, but we're just trying to help Robert look at it to make sure that that is in fact in place and well defined for you all.
Yeah, I need to follow up on that. Thank you.
Okay. Okay, we'll just put that as a follow-up item to get with you, Robert, on that and make sure that the committee's comfortable with what you have, or if we can help.
When I find it, I'll send it out to the whole committee
Okay.
as well.
And I think that covers it from the agenda standpoint.
So there is one item for us, for Utah County, and Brandon. Oh, yeah, Brandon's online to just give us a quick overview of how open enrollment went with our benefits plans. Brandon, just share with what you think the committee needs to know or would want to know.
No, certainly. I grabbed a few statistics. Just pulled them for you guys. So we had a total of 1,057 benefited employees go through open enrollment. And I checked, we had a full 2-week period for these employees to go through open enrollment. And as of like 11:50 p.m. on Sunday when we closed it all, we only had 139 employees who never touched their open enrollment. So really that was an 87%, participation rate, which I think was pretty good. So I think we do a good job getting employees engaged to at least look at their benefits. Our workday system is pretty good to carry benefits over, even for those that, didn't enroll in it. We had to do some manual things because we fixed a way we do HSA plans for employees over the age of 55. But, I think it was a really successful open promotion and closing of our open enrollment. A couple of the things that was interesting through the process I like to look at. So 85% of our employees are enrolled in a medical plan. So I always like to see, who's in what. And I think, we gained 7 more employees picking up that used to be on the PPO traditional plan. They opted into the high deductible plan, but then we had 4 employees that were on the high deductible plan that went into the PPO plan. So that's always kind of an internal thing for me, trying to figure out why employees are enticed on a PPO plan. But overall, 91% of all medical enrolled Utah County employees enrolled in our high deductible health plan. So that clearly leads the way as the medical plan of choice. So that was over 822 employees enrolled in high deductible plans. Dental enrollment, 88% of our employees were in dental. The interesting part of this is 1/3 of those are in the gold plan and 2/3 are in the platinum plan. So it's twice as more popular for employees to be in that platinum plan. And I'm looking at possibly removing the gold network and figuring out how to do a gold-based type plan in the platinum network next year. But that's something to maybe look at 2024. before, there's some options that our benefit broker talked to us about, but a lot of, high level of participation in dental. And again, these numbers are all up from the prior year as well. Vision, we had only 56% of our employees enroll in the vision plan. Of those employees, 414 are in the buy-up and 179 are in the base plan. So the higher allowance seems to be more popular. So a lot of maybe some opportunity at trying to get it to a single allowance at a favorable rate for everyone. And then our last plans, we had an increase in enrollment in our Voya voluntary plans. 430 employees went to our accident plan, 200 went into our hospital indemnity plan, and 285 in our critical illness. All numbers are increased from the prior year. So, no decrease in election of benefits. And I think that's just because, we take the time to promote, we bring in our benefits broker, we bring in vendors to do specific meetings, identifying changes in our plans and what each of our vendors offer. So it seems like we have a really good turnout and good election rate for our benefits. Anything else you'd like me to hit on specific?
No, that's a very good overview. Does anyone on the committee have any questions for Brandon in regards to our open enrollment? Okay, thanks, Brandon.
From an outsider, Brandon, I'm going to tell you 87% is pretty amazing. Way to go. That's a high number. That's really good.
It's all Brandon.
I mean, it's always frustrating to see the ones that didn't touch it, and then open enrollment goes by, and then they're the ones that have a problem. Like, oh, I wanted this one. It's like, you didn't even touch your enrollment. What do you expect to happen? So, but no, we don't point fingers. We just try to help them and make corrections if needed. So that this week, and last week was all spent helping those employees that felt they got locked out of the system. Making sure that they get the benefits that they want. So we're pretty flexible and always lean towards helping the employee.
Okay, great. Thank you. I think that's everything on the agenda. Does, Tyler, do you guys have any more from Soltis?
We will pull together the notes and action items and follow up from this meeting and, of course, send it out for review and approval.
Okay. Yeah, Bishop, anything else from Voya?
Sir. Thank you.
Okay. Jeremy, any comments for your first meeting?
I was overwhelmed and amazed.
I have to tell
I've
you,
taken a few notes that I've got a lot to learn.
yeah, it's only once a quarter, but this is actually one of the shorter ones. So anyway, it's kind of a warning. And no, we're very, like I said at the beginning, we're very happy that you're on the team. So it'll be good.
And
Anything?
Tyler said that someone on his group will reach out to me to give me the orientation, so to speak.
Yeah, we'll touch base with you, Jeremy, and we'd love to schedule some time. We can just kind of go through, I think, familiarize you on, again, the plan, kind of the processes that are in place, the documentation, governance, and then just help answer questions and make things hopefully a little less overwhelming for you. So,
Okay. Thank you.
Is there anything from the committee?
I just wanted to thank Soltis for that fiduciary training. I learned a lot. I was able to attend in person and felt that to be valuable for me to understand your process and what you do. Like, it very helpful for me to understand how investment options go on the watch list and the process that you use to vet things from a qualified versus a quantitative versus qualified and all of the things that to go into doing that, but very helpful. So I just wanted to thank you for helping me learn more about.
We're glad you attended. And those are, they really are. You guys as a non-ERISA plan, I think you don't really see from auditors for an ERISA governed plan. That's almost always an ask from an auditor. Is they'll say, show us proof of it, or they don't say proof of attendance, but they say, show us what fiduciary type of training the committee members have received throughout the year. So it's an important function. We're glad you guys have always been really good to be represented. I know Dave was always very good to be engaged there, and most of you have been. So we look forward to having you again. And in April, we'd love to have you, as many of you you'd like to come. We'll have some really great content.
I think you just, need to make sure it's warm in St. George in April.
Tim, I promise you it'll be warmer than it was this last week.
It's been kind of
Okay.
unpleasant.
So Ralph, I did send around the most recent version of our charter / bylaws in an email, a reply all. So they're from 2018, as far as I can tell. That's the most recent version we have. My encouragement is just take a look at those and we can talk about those in a future meeting.
All right, sounds good. All right, do we have a motion to adjourn?
We need public comment.
Oh, yes, is there any public comment? A PJ? No?
Anybody
Okay.
online?
No.
Okay.
No more Mexican wrestlers?
Yeah, we'll make sure that doesn't happen next time. Like I said, it could have been a lot worse.
Yeah, we know.
Okay, motion to adjourn.
So moved.
Second.
Okay, all those in favor? Aye.
Aye.
Okay, so moved. We're adjourned. Thank you.
Thank you, everyone.